Stocks see a sharp fall following renewed tension in West Asia following Iran's missile attack on Israel. Realty and automobile stocks are the biggest losers, with metals and oil producers being the two green spots.
Market regulator SEBI issues a tad less stringent final rules for F&O trades to protect small investors. Increases in minimum contract size, curbing weekly index contracts, stiffer margins and closer monitoring are some of the steps. Experts see these curbing activities in F&O going ahead.
Dabur says disproportionately higher growth in modern trade and e-commerce as well as quick commerce impacted general trade. It decides on a one-time measure of correcting traditional trade inventory. The stock dips.
Crude prices leaped following Iran's attack but cooled as OPEC Plus's idle capacity of 5.7 million barrels per day exceeds Iran's output of 3.4 million barrels per day. The possibility of a wider conflict, however, keeps the markets on the edge.
Good afternoon. You're watching us here on Halftime Report. West Asia tensions hit market. The Nifty is down almost 400 points. In fact, it's below that 25,400 mark as well. The bull market has a fair amount of walls to climb in terms of worries. We not only have the West Asian market, West Asian geopolitical tensions. We also had the SEBI circular that came by to curb F&O volumes. And at the same time, we had weak updates coming in from corporates, including the likes of Dabur. And add to all of that, just to put a little more spice to the mix, we have the Nifty weekly options expiry playing out today. I'm Manglam Malu. With me, as always, Ekta Batra. Ekta, what a cocktail of news this afternoon.
Yes, absolutely. And after the heady runs that we've seen, people are not used to seeing so much red on the screen. But definitely at this point in time, we have the markets which are under pressure as the Middle East conflict has deepened. So that's primarily one of the reasons. And what it could probably do potentially to crude prices. Asia also largely mixed while Japan rallied. We had the Hong Kong markets which were quite weak, so it's recovered from the day's low. So that index was down around 1.3%. We have Europe, which is set for a weak start as well. So maybe the CAC futures should come up for you, the French futures, and let's see what they are indicating at this point in time. Besides that, we do have potentially a lot of data to watch out for, which would determine the course of the markets, determine the course of the Fed as well. Not to mention that geopolitics would probably be key and top of mind for the US Fed going forward as well. So we have the jobs data in the US on Thursday, and we have the September payrolls data, which will be coming out on Friday as well. So a lot to watch out for. It's going to be quite a lot of information that the markets will reckon with. And over that, obviously, earnings season starting soon. So that will too determine the course of the markets. But let's focus on some stocks on the move. Manglam is tracking Dabur and Marico. Well, nobody expected this kind of an update, Manglam, from Dabur.
Most definitely, and that's exactly what is reflected in the stock price as well, Ekta, because after the fourth quarter results and after the first quarter results as well, the management did reiterate that demand conditions were improving. At the same time, they are gunning for that double-digit revenue growth in this year itself. No problems with the demand condition. They're stable and they haven't seen further deterioration. Rural still doing a lot better. But there were a couple of problems during the quarter that went by. The first one, heavy rains and floods across parts of the country have impacted their out-of-home category, which is the beverage category, most notably the juices category. And that's impacted their revenue. And secondly, because of the high growth that we're all celebrating here on quick commerce, e-commerce, modern trade, there is a fair amount of inventory which is stuck in general trade, which still accounts for nearly 90% of the sales. So the company has gone ahead and announced a one-time restructuring of all the inventory in general trade, and as a result of which their revenue in this quarter will decline in mid-single digits. And on the back of that, their EBITDA will be impacted as well. The margins will be closer to 15 to 19%, mid-teens to high teens, as the company has said, as against their earlier guidance of 20% itself. The stock had done well, but now it's off about 100 rupees from its 52-week high on the back of that. But not all is lost, because they do believe that October is going to see some sort of recovery. At the same time, the inventory realization for general trade is temporary, and parts of their business, which is the international business and Badshah Masala, which they acquired, are still growing in double digits. So we'll keep an eye out on that one. On the other hand, if you look at Marico, that stock's holding mildly in the green in an otherwise very weak market. And why is that? Because their performance has not been bad. The consolidated revenue growth remained in high single digits. At the same time, parts of their business did well. Overall volume growth is mid-single digit as well. The most important positive for me, Ekta, is that last quarter we saw Marico see a big decline because of the turmoil that we saw in Bangladesh. Because a lot of their international business comes in from Bangladesh. But out there as well, despite the turmoil, the companies reported high single-digit growth in Bangladesh, speaking about the resilience of that business, allaying some of the concerns, and that's why the stock's holding even better. The only reason why it is not booming in today's trading session is because operating margins may lag the growth in revenue, which means that there could be some compression and limited triggers for margin expansion given the sort of worries that we're seeing geopolitically as well. So base oil prices may increase. So that's one thing that we need to closely monitor. But Marico, no problems, no real problems. Dabur, there were problems. Let's see when they come out of those problems.
Okay, all right. So definitely a space to watch out for, considering the dynamics which are taking place in the QSR space as well. Thanks, Manglam, for that. So Dabur and Marico in focus. We need to take a short break on that note. But up next, we'll focus on steel stocks and a lot more. Stay tuned. Welcome back. Well, for the market, still weak as we speak. So the Nifty is down around close to 400 odd points. So lost that much. The mid-cap index is down around to 860 odd points at this point in time. And the bank Nifty has shed over 700 odd points. The advanced decline ratio has been weak from the get-go. So currently stands at around 1,200 stocks advancing to around 2,800 stocks declining. So it's 1:2. In terms of a ratio at this point in time on the Bombay Stock Exchange. So as you can see, extremely wide and favoring the declining stocks. But nonetheless, we have a couple of stocks which are in focus now. Jubilant Ingrevia is in focus from the agrochemical space. It surged as its subsidiary has entered a deal with an agrochemical company. Sonal is here to tell us more about this particular deal and what it means for Jubilant Ingrevia.
Well, it's a big pop-up that we're seeing on the stock, especially in a weak market like this. Jubilant Ingrevia, the wholly owned subsidiary of the company, which is Jubilant Agro Sciences, has entered into an agreement with an agrochemical company. The company says it's one of the largest that we've seen in the globe. That is the size of the agrochemical company. This is to produce an agro intermediate for one of the key agro actives of the customer. The point that the street seems to like is the consideration, which is $300 million plus, which is huge for the company, and that is something which would have a direct impact positively on the P&L as well. The company says this will be over a period of next few years after the commencement of production. It will be over years that they will get this consideration. Nevertheless, it will be positive. The subsidiary will be investing in a facility going forward. So we don't know the investment amount here. So these are some important details we'll be watching out for. What will the asset turn be for the kind of investment that they are taking here? The manufactured agro intermediate will be exported from India. So it's largely an export-oriented product. So what are the kind of margins they will enjoy? That is something we need to know from the management. But overall, it's a positive deal that they have entered into, and that's why that uptick on the stock today.
Take that point, Sonal. Thank you so much for that. In fact, that's not the only stock that we're talking about in terms of gains. Steel is one sector which stands out, and two stocks in particular doing well. This on the back of notes coming in from Morgan Stanley and Nomura. Nigel joins in with why JSPL and JSW Steel are doing well and what's the way ahead for the steel sector. Nigel.
Well, that's right. Let's start off with Morgan Stanley. They're fairly positive on steel. They say that the China's recent stimulus, well, that bodes well, both in terms of sentiment and it also could give some kind of base to steel prices. The other worry has been that we've seen a high amount of imports coming into India, but they believe that, in fact, that will cut down. And in turn, if imports stop coming in, then we'll see some support to pricing as well. And that's why they believe that in the near term, there'll be some short-term green shoots that will be visible in steel spreads. They also go on to state that domestic steel prices were at a premium by around 8 to 9% in comparison to imported steel. That always poses a risk that the domestic prices could be cut. But now they say they've evened out. Domestic price of steel, if you compare it with imported steel, well, it's more or less at par. And because of that, they're optimistic now that steel prices would have bottomed out and will move up from here on. So they are raising the pricing estimates and in turn spreads, which results in higher target prices and turning their rating on some of those stocks as well. Starting off with JSPL, they've upgraded the stock. Now they have a target price of around 1,200 rupees. On JSW Steel as well, they have hiked the target price around 1,150 rupees. On Tata Steel, from underweight, now they have an equal weight and they have hiked the target price around 175 rupees. On sale, they were underweight, they maintained the underweight stance, but now they've increased the target price around 125 rupees. That's what Morgan Stanley has to say. Moving to Nomura, they've initiated coverage both on JSW Steel as well as JSPL, and they have a target price in the vicinity of around 1,200 to around 1,220 rupees. They are citing strong demand, which will hold them in good stead. Continued deleveraging has kept some of these balance sheets in very, very good shape. And also on the cost side, since these companies are focused on the cost side, those benefits will flow through as well in the coming years. And they highlight the Chinese factor, that Chinese HRC prices are trading at trough levels. And from here on, it could get some kind of base. We had made this point earlier as well. Very few Chinese producers are making any kind of money. So that's why that was calling for a bit of a basing out in terms of Chinese steel prices. They highlight a few risks as well. Suppose domestic demand weakens a little bit. Suppose there's monetary tightening. And if there's delay in any of these projects that they are, that they have already outlined in terms of an expansion, those could be risks. But all in all, Morgan Stanley as well as Nomura, they are positive on a select couple of names in the steel space. Back to you.
Okay, all right, Nigel, thanks very much for that. So that's what's buzzing in the entire steel space. But Petnet LNG is in focus after MK has upgraded the rating to a buy. Sonal is back with us and she has more on this.
Well, yes, MK is very bullish on Petnet LNG. They've upgraded the stock to a buy. They've increased the target price by 16% to 425 rupees a share. They reiterate their positive view. They say on the back of steady outlook and attractive valuation, the hedge utilization was strong in Q1. It was driven by power sector because we saw that peak summers as well. That has cooled off, but they expect higher utilization levels to continue. They believe 100% is achievable for the rest of the fiscal as well. The commencement and ramp up of Exxon's contract with higher Kochi tariffs, these would be the two big triggers going forward for the stock as well. And this is something which will lead to EPS upgrades of around 7 to 9%, better than what they had expected earlier for FY 26-27. The tariff outlook following Qatar gas renewal and calendar year 2028 has been a concern because a lot of the customers, they have been asking for revising those tariffs downwards. However, the management has reiterated any cut won't be material and minority shareholders' interests would be protected under this. So they build in reasonable assumptions, but they still see a lot of value in the stock. They think it is trading at around, they're valuing it at 14 times 1 year forward earnings. So they see a lot of value going forward.
Right, take that point. Thank you for that. And in light of all the stocks which are buzzing around, another one to that list is BSE. Following the SEBI's measures to curb speculative F&O trading, Vamakshi joins in with what brokerages have to say on this up move. Does this, Vamakshi, mean that, people curbing trading on NSE is advantage BSE?
Well, absolutely, Mangalam. NSE's, pain is expected to be BSE's gain. And, of course, this is on the back of the measures introduced by SEBI. One of these measures is limiting weekly expiries to one benchmark per exchange with effect from November 20th, 2024. And, in fact, analysts are expecting the highest impact to come through this particular measure. Now, IIFL Security says that the impact for NSE is expected to be relatively higher, given that it has 4 weekly expiries as compared to BSE, which has 2 weekly expiries. In fact, they've gone ahead and quantified the impact of the same. Around 35 to 40% impact on NSE option premium turnover is what they expect, and for BSE this is much lower at 15 to 20% impact. Earnings impact, however, for both of these exchanges is expected to be lower as compared to the turnover impact, and that is because they've now moved away from a slab-wise structure to a flat tariff-based structure. They're estimating a 15 to 20% hit on NSE's FY26 EPS. For BSE, again, this is much lower at 5 to 7%. BSE's option tariffs additionally are nearly 7% lower as compared to NSE. So IIFL Security says that to that extent, BSE does have an opportunity to offset the lower volumes impact. Additionally, BSE's market share gains could accelerate, and thereby it could further negate the earnings impact that could come through from these tightened F&O regulations. The key overhang, they say, is now behind us. The long-term growth potential remains quite intact. There continue to be quite constructive on the sector, and they have highlighted that any meaningful correction in these stocks is an opportunity to add. So overall, BSE is relatively better placed as compared to NSE, and that is the reason why the stock is surging in the trading session today.
Okay, all right. Well, somebody's loss is somebody's gain. Thanks, Vamakshi, for that. Well, for the markets, we have only just about 5 stocks which are in the green for the Nifty. So, gives you a sense about the kind of declines that we're seeing. So, only around 45 stocks which are trading in the red. We'll do one thing. We'll take a break, but we'll full tilt on the markets. Up next, Aditya Agarwal will join in to tell us what his technical calls are in what is quite a weak and volatile day.
You're watching us here on Halftime Report. Perfect time to get you, the market set up at midday itself. It's a big fall that you're seeing, almost 1,000 points of the mid-cap index, which was a relative outperformer in the first hour of trade, but thereafter has seen a big decline. The Nifty now below that 25,400 mark as well. These, numbers don't do justice to the pain that we're seeing in the overall market itself. So the next plate comes up for you. All the sectors, it's a sea of red and near ocean of red, 2% lower for the Nifty Auto Index. Even the metal sector, which is actually a relative outperformer today, has declined by almost 0.4%. The pharmaceutical index lower by 0.33% as well. Some of the high beta names like Nifty Realty, as well as some of the financials doing even worse. And we have the energy stocks as well, lower. A large part of that are crude sensitives too. So just keep an eye out on this space, led lower, of course, for the energy sector by all the oil marketing companies. When everything falls, what rises is the volatility in the market. And that's exactly what we're seeing here. The India VIX is up nearly 10%. In fact, from earlier this week levels, it has actually rallied about 20-25 odd percent itself. Add to all of this, we have the Nifty weekly options expiry playing out today as well. And we've broken important levels, the 20-day moving average on the Nifty Bank as well as the Nifty. Now the next level of support for the Nifty at the 50-day moving average comes in closer to 25,000 itself. Let's hope that level, for the bull's sake, does not come in today's trading session at least. So we'll watch out for that. Why do I say that? Because if you look at the way up, there has to be a lot of call writing that we're seeing today, closer to that 25,500 mark, telling you that levels upwards of 25,500 will continue to see some amount of supply. These are options that expire today. 25,400 put has some writing as well, 1 crore shares outstanding. So if we sustain below the 25,400 mark where we are at right now, there could be further unwinding out there all the way down to 25,250. Why do I say that? Because 25,300 put has the maximum open interest in all the options that expire today. So keep an eye out on that. And a lot of individual stocks in focus as well. So in particular, I'm watching out for Granules, which is doing well in today's trading session, may enter F&O ban, and Manappuram Finance as well. Down 3% today, may enter F&O ban too. So that's about the market setup at midday. Good time to get in a quick technical check as well. Aditya Agarwal joins in. Aditya, your thoughts on the indices and individual stocks? It's really a sea of red.
Oh, absolutely, Mangalam. And this is something which I think a lot of analysts and traders were hoping for, a correction in the market, because we had seen a one-way rally in our markets as well. But yeah, the magnitude of the correction has been massive just in one trading session. We are coming very close to key support area of 25,300, which you also pointed out as the zone where maximum put open interest is also built up. This is the place from where we had seen that sharp rally in just few trading sessions from 25,300 all the way to 26,100. So now that should act as a key support area on the downside. If somehow bulls are able to hold that area of 25,300 in today's trading session, and we get a kind of a consolidation in maybe second half of the trading session or tomorrow, then I think we could be in for a short covering rally at least at levels of 25,500 to about 25,600 on the upside. The bank Nifty is where we are seeing the maximum pain point. And NBFCs, which had been outperforming all this while, are seeing a bit of correction in trade today. So 52,000 on the downside for Bank Nifty is a key support area for me. If 52,000 is broken, then we could see further downside in some of the banking names, especially the large cap banking stocks. So both 25,300 on the downside and 52,000 on the Bank Nifty is somewhere I'm eyeing very closely. If we're sitting on shorts, maybe we can continue to ride onto the short positions, especially on the Nifty and the Bank Nifty. If somebody is looking to enter fresh short on the index, I would avoid now the index short trade. Maybe one can go for a stock-specific short trading ideas, which still offers some downside there in a lot of these stocks.
Okay, so any specific stock trading ideas that you would recommend at this point?
Yes, I've got a couple of short trades. The first is Apollo Hospital. If you take a look at stock, had been going up one way, and in trade today, stock has broken down from a rising channel on good volumes. Looks like there is more downside here. So at current levels, one can initiate fresh short in Apollo Hospital for a target of 6,700 on the downside, with a stop loss at 6,950 to about 7,000 on the upside. The second is from the auto name, auto major Tata Motors. This is one stock which has been underperforming for some time now, even before the market started to correct. And in trade today, it's broken down from its 200 DMA, which was a key support area all this while. So a trade below 200 DMA doesn't augur well for the stock. So I think there's more downside here. One can initiate a fresh short for a target of 890 on the downside with a stop loss at 940 on the upside.
All right, take that point. Thank you, Aditya, for joining in and giving us your stock picks. Ekta, you had a question?
Well, just wanted, if we still have Aditya with us, Aditya, just wanted your sense, because just in the past couple of minutes, there's been an extension in terms of the losses that we've seen. We have the Nifty, which is now down over 400 odd points. We have the mid-cap index, which is, possibly going to race towards a 1,000-point cut. In such a market, where would you find spaces of, say, safety?
So, Ekta, clearly the two spaces where we can actually look as safe haven, one is IT, even though IT is correcting today, but I think IT will be the first to bottom out and we can see a reversal in the IT sector. The second will be FMCG for sure. And these are both the sectors, if you take a look at the way these both sectors have been performing for some time, they have been outperformers. This showed that people were moving away from high beta names to low beta ones, run for safety, which is FMCG and IT. So my sense is if you see further downside in the market, these will be the two sectors to hide and maybe go long on. So IT and FMCG. Within IT, maybe look for large cap names like an Infosys, TCS or NCL Tech. Within the FMCG pack, Colgate, Palmolive, Britannia, Hindustan Unilever, all of them look attractive to me. And this minor decline that we are seeing in trade today offers an opportunity to go long on these two sectors, especially the IT and the FMCG. So for me, two safe havens are FMCG and IT as of now.
All right, take that point in particular on the IT and FMCG space and those names as well, because Dabur is actually underperforming from the FMCG pack. Just before we slip into a short break, pull up the intraday chart of Alembic Pharma. It's a big surge that we're seeing, counterintuitive to how the market has been for all the other broader market names. Mid-cap index is down 1,000 points, but Alembic Pharma at the high point of trade, having rallied about 8% from today's low itself. Take a short break, come back. We speak about, fundraise, our PE corner. And today we have with us the experts from Grant Thornton.
Welcome back. Still tuned to Halftime Report on CNBC TV18. Well, it's turning out to be a rough session for the markets. The India VIX, like we pointed out earlier, has also spiked up quite considerably today. So up around 10-odd%, giving you a sense in terms of the volatility or the anticipated volatility, which is expected currently up around 10% at 13.2. But let's talk about the deal activity, which has been positive. Q3 2024, in fact, has witnessed a notable surge in deal activity with 618 deals valued at $26.9 billion. M&A volumes reached a record high, witnessing 214 deals valued at $11.4 billion, 337 PE and VC deals worth $7.6 billion, and Q3 also saw 42 QIPs worth $6.5 billion. What's the way ahead? Sumit Abrol, the partner at Grant Thornton Bharat, joins in now with his perspective. Sumit, hi, welcome to the show. If you could just start by giving us a sense about what the deal activity is looking like in Q4, because we're coming from a really, big pedestal in terms of the M&A as well as the PE/VC deal activity. But is that going to continue into Q4? What's the pipeline looking like?
Thanks, Ekta, for having me on the show. And as you rightly pointed out, I think Q3 has seen a very significant surge after a rather subdued 2023 that we saw for deal markets. I think 24 has been a much better year, where I think corporate India's appetite for growth and inorganic expansion continues to be high, both in terms of domestic M&A activity and also on the cross-border side. I think outbound is something that really stands out, with about 50% increase in volumes on domestic M&A, doubling of volumes on cross-border outbound. I think some very clear, interesting themes playing out there. And also on the private equity side, and that's a segment which has seen very stiff competition from public markets with the surge in IPOs and new public market listings that we've seen. But despite that, I think the private equity trades have also held up, very consistent across all quarters, and are looking strong in terms of pipeline for Q4 as well. But at the same time, also I think some interesting themes there lined up for Q4, where I think Indian corporates will continue to buy for capability, for filling in the capability gaps, versus just to buy for scaling up and bulking up their positions or for consolidation. That's, I think, one theme which is likely to continue into Q4. And also on the private equity side, we are likely to see more control deals, more buyout deals, more platform deals. In fact, an interesting publication that GT Bharat has, we call it the Fourth Wheel publication, which tracks the financial sponsor activity. And one of the recent surveys that we did there very clearly talks about 86% of those investors on the street expecting far more increased allocations for the country in the coming times. And 48% of these investors foresee an exceptional activity for Q4 and beyond. So I think overall belief in the Indian corporates to create value continues to be strong.
Well, the expectations on one side, the activity is on the other side, because yesterday we heard from, notable investors looking to trim their positions in India as well, peak XV, and we also have Chris Wood looking to reduce their exposure to India. I wanted to ask you, Sumit, is there anything underlying which this data is perhaps unable to capture also? Because while the activity has been high, the volumes have been high, they've also been fat-tailed by a couple of things. One, Zepto, the kind of fundraise that it has been doing over the last few quarters, that's one. Second one is Bharti Enterprises acquiring 25% stake in British Telecom. That's a one-off. It's a $4 billion deal. And then you had about 8, acquisitions made by Nazara Tech. If you take those off, which, one may think of as non-recurring in nature, then does this hold up in terms of a trend?
So, Mangalam, I think one of the other things which also needs to be seen in conjunction here is how are some of the other sectors playing out. I think the unicorns are back in flavor. The trades in early stage businesses, startup ecosystem have gone up considerably. Consumer and retail, for example, we saw volumes of over 100 deals in this quarter. Technology, which is IT and ITCS, saw close to about 80 deals there. BFSI, again, a sector in motion with seeing a lot of investor activity and M&A, about 60 plus deals there. So some of the larger deals that you're speaking about, I think some of those outliers have existed across all quarters. And even in previous years where we've seen activity surging to excess of $120 billion in overall values, which have been I think the highest recorded values for the deal street. Even those have been characterized by a few outlying large big ticket platform level acquisitions and trades. So these are themes which continue to play out. But in addition to this, I think some of the sectors, and within those sectors also, there are certain sub-segment themes which are gaining traction. For example, manufacturing, there is high value added manufacturing is seeing a lot of action in spaces like aerospace, in defense, areas of agri. These are spaces which historically haven't seen that level of deal activity, but things which are coming out quite significantly in the last couple of quarters. For example, aerospace and defense saw like 46 deals, if I have my numbers right, for the YTD 9 months of this year. So I think overall a mixed bag. The outlook in terms of the deal activity continues, and even the pipeline that we are seeing from private equity investors and the kind of platform transactions that are being put in play and that are being constructed as we speak continues to be quite strong.
Okay. Well, these are interesting sectors that you did speak about: manufacturing, defense, agri. Is the deal activity the maximum within those sectors? Where are you seeing deal activity take place in terms of sector-wise, probably towards the close of the year and going into next year as well?
Yes, so Ekta, I'd like to break that into two parts: activity in terms of volumes and activity in terms of value. Volumes, as I said, with unicorns back in flavor, we are seeing volumes go up in consumer-oriented spaces, e-commerce, startups, healthcare, which is seeing a lot of volumes, and we'll continue to see that kind of traction. On values, I think some big ticket transactions lined up in sectors in energy, particularly renewables, infra, and some of these private equity-backed consolidation control deal platforms are spaces where we see increased level of values being contributed to the deal market.
All right, and final question then. We didn't see a lot of activity in the third quarter in the infra space, the manufacturing space. Do you think that's returning?
Manufacturing, as I said, the themes are around value-added manufacturing. And infra, as I said, there are deals in pipeline which will hopefully see the light of the day and closures. There is a market dislocation on pricing, which public market valuations have created, which has emerged as one of the concerns also in that fourth wheel survey that I was talking about from the financial services sponsors community. But I think that some of those trades will hold up, and we will start seeing more action in private equity-backed positions in manufacturing and infra buyouts.
Okay, all right, Sumit, we're going to leave it on that note. Pleasure speaking with you. Thanks very much for joining in and talking to us. We need to take a short break. More on the markets once we're back. Stay tuned.
Welcome back. The market continues to be lower, almost 400 points lower for the Nifty, but there is some sort of recovery for the mid-cap end of things. We're seeing a couple of stocks pick up from lows of today's trading session. Why do I say that? Because pull up, not only the mid-cap index, there you have a smidge higher from the lows. You have L&T Finance trying to make a bit of a comeback, Navin Fluorine trying to make a bit of a comeback. Both these stocks up about 2.5% from the lows. PVR Inox 2 is closing in at the lower, off the lower levels of today's trading session. Mind you, they're still in the red, but have seen some recoveries. No such respite for the frontline indices, still sitting at the low point of today's trading session, with the stocks in the broader markets the decliners far outnumbering the advancers. Almost 1,800 stocks in the red for just about 600 in the green itself. Good time to, throw it open then to the commodities arena. Manisha Gupta, as always, joins in.
Well, thank you for that. And I have a very special guest with me. Sachin Jain is India head for World Gold Council. Sachin, thank you so much for joining us. And it is a time when most of the tangible commodities really seem to be doing well. So whether it's energy or base metals and especially precious metals as well, if you look at the geopolitics kind of global trend data in sense of debt that we have, which is near record highs, and of course, expectation of another rate cut coming in the month of November. But even with all of this, we haven't seen yet another leg up in sense of rally. I mean, I do get a point that it is nearly $600 up from the lows of this year. But how are you reading the global markets and what's your sense on the gold?
Thanks, Manisha. Thanks for getting me on. And as you said, it's kind of a dichotomy that we are sitting on in terms of where the prices of commodities are heading, and of course the precious commodities as well. If you reflect just in the last 3 weeks, the first increase, of course, was an outcome of the Fed cut, how the US dollar weakened, and of course gold becomes more interesting for whole investor community. That compounded by the current geopolitics hasn't seen that much up, as you said. But I think a large part of all these, perhaps, these triggers were already incorporated in the way prices of gold are today. So we have to really be very carefully watching out the price of what's happening in the geopolitical situation. And I think that the large jumps that were based on any logic and based on reasoning and based on statistics have been very well incorporated already in the current pricing that you see.
Sachin, we've been talking to a lot of jewelers, as you would have been doing as well, and they tell us that while August was good, September must have seen a 10 to 12% of a decline in sense of sales. And if the prices continue where they are and if move any higher from here, then the Diwali quarter isn't going to be so strong.
Well, I think it's something that we've seen, year on year, and I would say through a decade, Manisha, where whenever the prices of gold have gone up, consumers tend to sort of slow down, watch it, and then get used to a certain price. We saw it. I mean, this year, 2024, has been a record year, as we say. We've seen 30 price, highs ever, 30 of them this year. Now, if you do a bit of analysis of these 30, most of them have been similar, where price went up, consumers get warmed up to that price, and they come back. Now, of course, it's going to impact, because if for an X price point you could only get a certain jewelry, yes, I mean, the household incomes haven't gone up in that fashion. The only, I think, I would say the sublime factor that we have to keep in mind is there are prices of gold in July were at a certain level. With the custom duty, it went down. And with the increase of gold price, it's going to be at the same level. So I think Indian consumers are quite, I think, inclined towards gold purchases. There's of course a great love for gold, and in the current pretext of how gold has performed financially, I believe that consumers will come back. Yes, September has been a slow month, and for the right reasons of same economic and same sort of always response from the consumers that when prices go up, they tend to be a bit of a hold.
Going forward from here, and I do understand that World Gold Council has been doing a lot of gold campaigns across the country. What is the kind of feedback, partnerships that you are looking at during this festival season inside?
I think the interest of gold is an all-time high, Manisha, for all right reasons. When in terms of diversification of your portfolio, the interest of ETFs on one side of the financial markets, and also if you look at the jewelry side, the consumption, the inclination of consumers coming into the stores will be very, very high. The market is getting ready. We've seen in the last 2 months, right from IHS onwards, and recently there was a GJC show, we've seen that the industry from a jewelry perspective is getting ready. I'm very certain that the consumers will be witnessing some great creativity and some really amazing products on the floor. But I think also on the other side, the financial markets in India are doing really well, and gold is really has been a glittering factor in that area as well. So I think for the balance of the calendar year of 2024, we're pretty positive as to how gold should be rallying out in the next 3 months, 4 months.
Also, Sachin, there are various reports suggesting that the way the gold prices have been rising, the budgets have been as much, so you might see a decline in volume rather than value, which continues to be higher, but also on how gold really soon seems to be becoming a more of an investment product rather than jewelry. How are you looking at those numbers?
Well, actually, Manisha, if you look at the Indian context, this change of pretext of whether gold is a investment product has it's been a part of our culture, of our veins through ever. Now, there are more financial products that are of course getting more popular, and I only see one direction of travel, that is the younger consumers getting more and more interested in gold as a financial product. But I think if you look at India in as an overall market, then you have to keep in mind that 70% of our market consumption happens in rural markets. We've come out with a very positive monsoon. Those are things that are underlying factors which we have to look at. And they all have always, I mean, historically and even today, connect to the consumption of gold. So, I think investment and jewelry tends to be a bit of confluence in a large part of India. I mean, you look at the gold loan market, which primarily runs on jewelry, so it's a financial sort of an asset that you can leverage. And on the urban side, we certainly are seeing much increase in the financial products. So I think both are here to exist, both are here to stay. But I think in the coming years, you'll see more technological sort of products going in. Even I think that both these industries would influence together and be almost similar.
All right, interesting conversation there out on gold, which is the only metal which is closer to an all-time high in a time when the markets are seeing a bit of a decline. So what we'll do is we'll take a short break, come back, get you more on other side of the equity markets, which is basically all the frontline indices and individual stocks. Wrap up on halftime report. Business Lunch takes all the market action ahead. Welcome back. You're watching us here on Halftime Report. We're speaking about the markets. Keep an eye out on a couple of these stocks which are now trading the lower end of today's trading range. Interglobe Aviation is the most notable of them. Buoyed also further by lower demand environment and also higher crude prices. Crude prices hovering towards that $75 per barrel mark. Interglobe Aviation at the low point. IRCTC itself too has moved towards the lower end of today's trading range. Persistent Systems, a stock that did well all of last week, has now moved to the low point of trade as well. So just keep an eye out on that one. A bunch of stocks which are trading the lows of today's trading session, along with the frontline indices, where you do have the Nifty still sitting with a cut of almost 415 points. An important next session of trade coming in after this short break. We've wrapped up on Halftime Report.